Hey, I'm Jess with Nurse Who Knows, and in this video we're going to be talking about open enrollment. We're going to dig into some of the options that may be offered by your employer during this period of time and make sure that you have the information that you need in order to make the best choices for yourself and for your family. So why is this important? What is open enrollment? And who needs to participate? Open enrollment is a specified period of time, usually a couple of weeks towards the end of a calendar year, where your employer is going to offer access to opt in, sign up for, enroll in, or opt out of benefits offered by that employer. Some of these benefits are going to include healthcare, vision and dental, as well as disability insurance, maybe even life insurance, and for some companies, it also includes retirement options. So it's really important to know what benefits are being offered by your employer, as well as what benefits are going to be the best for you and your family considering your situation. These benefits differ by cost, by what becomes available to you, and a lot of other factors. And so we're going to dig into what some of those differences are so that you can best understand and make the best choice you need to for your family. So one of the keys with open enrollment is that it needs to be done during this specific period of time. Again, usually a couple of weeks towards the end of a calendar year. So the open enrollment period that may be available to you right now is going to be open for the next calendar year, namely 2025. However, if you do not sign up during this window, this period that is open to you, then you may lose out on the option of changing, adjusting, or enhancing any benefits that are available to you for the next calendar year. Once this window has closed, you won't have the option of making any changes to your benefits or coverage that you've elected or opted out of unless you have what's considered a life-changing event. So these events include marriage or death of a spouse who may have provided some benefits or coverage, the birth of a child, or other life-changing events such as these. But outside of those events, your benefits and your coverage is going to be locked in for the next calendar year. So that's why it's so important now that we make sure that you know and understand what these options are so that you can make the best choice. So who should participate? Everyone who has employer-offered benefits should look to review to make sure what benefits have changed, what new benefits there may be, and what things are going to fit their family's needs for the next calendar year. So if you fall into one of these categories, you should definitely participate or at least read through what the offerings are for this year. One of the important things to know before starting the enrollment is understanding the difference between some of the health benefit plans that may be offered by your employer. So we're going to review through a few of these. Let's start with Health Maintenance Organization, or HMO. An HMO is a plan that many people are familiar with, but it requires you to establish care through a primary care physician, or PCP. This PCP is going to be your point of contact and the person that you select to ultimately direct your care, because any other services you need outside of seeing that PCP, you will have to be referred to by that primary provider. So if you need to see a specialist, let's say a podiatrist or a cardiologist, you would need a referral from that primary care provider in order to see one of those specialists. And with an HMO, they have a very specific provider network. So all of the specialists that you would be allotted to see would be included in that provider network. So before signing up for a plan like an HMO, one thing to consider is if you are already established with some specialists or providers that you like and have a good relationship with, do they fall into that network of providers covered in that HMO plan? If not, the cost out of pocket for out-of-network care is extremely high. One of the benefits of HMOs is that they typically have lower premiums than some of the other types of insurance plans offered. Now, the premium is the amount of money that's going to be coming out of your paycheck every 2 weeks or however often you are paid to pay for your health insurance. That's considered your premium. So often these plans have a lower premium. However, if you do prefer to seek coverage or providers that may fall outside of that provider network, then an HMO plan may not be the best for you if there are other options, because all out-of-network care would be an out-of-pocket cost. A PPO, or a preferred provider organization, is another type of health insurance plan that may be offered that you may be eligible for through your employee benefits. One of the differences is that with a PPO plan, you're not required to get referrals for specialist visits through your primary care physician. So if you decide that you need to see a specialist, your insurance then will not require you to go to your primary care physician first, then get a referral, and that referral be approved by them, and then you can make an appointment for a visit with a specialist. You can go directly to a specialist and make an appointment with them without having to go through all these other steps. That's one of the benefits of a PPO. With a PPO plan, you are able to see doctors that fall outside of their network. However, it will be at higher cost to you, but usually there is an in-network provider cost, and then there's an out-of-network provider cost, and the out-of-network provider cost is a little bit more expensive. And so that will depend on your plan, and that's something you'll want to look into in case one of the providers that you choose to see falls outside of the provider network. But there is coverage for out-of-network providers with this type of plan. Now, PPOs do tend to have higher premiums, and so the amount of money that's going to come out of your paycheck is going to be a little higher with this plan, but it does give you the flexibility to go to specialists without a referral from your primary care doctor and to see out-of-network providers at only a higher cost, but still have some out-of-network coverage. Another type of plan that may be offered is called an EPO, or Exclusive Provider Organization. With this type of plan, it's similar to a PPO. You do not require referral from your primary care doctor to see specialists. You can go ahead and make those appointments yourself. However, unlike a PPO, there is no access to out-of-network care outside of a case of an emergency. So let's say you have an emergency, you have to call 911, and they take you to a hospital or an emergency room that falls outside of your provider network. As long as it's deemed an emergency, that is okay. But if you individually elect to go to an out-of-network provider for care as a specialist or whatever the case may be, you will be left with the full cost of that out-of-network bill because there is no out-of-network coverage. One of the benefits that people like with an EPO plan is that the premiums tend to be a little less than the PPO plans, but you do have a little bit less flexibility as you cannot seek out-of-network care, or you will have to cover the full cost of that care. The next type of plan we're going to discuss is a POS, or Point of Service Plan. This type of plan is a little bit different. It's a mix of some of the features of an HMO and some of the features of a PPO plan. Like with an HMO plan, in a point of service plan, you are required to select a primary care physician, and that physician is going to be responsible for referring you out for specialized care. However, with this plan, you are able to see out-of-network providers, like with a PPO. And again, seeing those out-of-network providers is going to come at a higher cost to you, but there is some coverage in your benefit plan for out-of-network providers. With these plans, they encourage you to seek in-network care by having a lower out-of-pocket cost for in-network care, but you do have the flexibility to choose out-of-network care if that's what you prefer, and they tend to have moderate premiums. The next type of plan we're going to talk about is a high-deductible insurance plan, or a high-deductible health plan. This plan is one of the lowest premium option, and the reason why your premium is so low with this type of plan is because the deductible is the amount of money that you have to pay out of pocket before your insurance benefits kick in. So with this type of plan, your deductible may be as high as $2,000, $3,000, $4,000, or even $5,000. But because of that amount that you're putting out before your health insurance kicks in, your premiums tend to be very low. Now, with a high deductible health plan, you do have access to a benefit that you're not eligible for with any other plan, and that's a health savings account. And we're going to briefly also talk about the difference between a flexible spending account and a health savings account in just a minute. Now, again, with a high deductible health plan, this could be beneficial to some. With your premiums being low, you're going to see more of your paycheck, which is great. However, when you do need care, before your insurance kicks in, you have to meet that deductible. So if that deductible is $1,500 or $2,000 out of pocket a year, that means that's how much you're paying out of pocket for approved and authorized services for your insurance before your insurance then comes in and usually splits the cost of the remaining coverage with you. And that's called your coinsurance. So with a lot of high deductible health plans, once you've met your deductible, whatever that amount is, then your insurance starts to cut the cost or split the cost of your care needs with you. They may have a set copay for certain visits like a primary care visit, but for things like emergency room stays or hospital stays, there may be a split of 80-20 or 90-10, where you'd be responsible for the 10% and the insurance would pay the 90%, or you would be responsible for the 20% and the insurance would pay the 80% once that deductible is met. These high deductible plans are usually best for people who are younger, healthier, and don't anticipate having very high healthcare related costs, may only see the doctor for an annual physical each year, and not have very much that they need to spend on radiology exams, don't anticipate a lot of visits to the emergency room or hospital, or a lot of prescription costs. For these people, they benefit because it gives them access to the health savings account, which we'll discuss now. So we're going to go over some of the differences between a flexible spending account and a health spending account. And these are going to pop up on the screen for you. So we're going to start with flexible spending accounts, also known as FSAs. These are available to anyone whose employer offers that type of account, regardless of the type of insurance plan that they have. The annual contribution limits can change year to year. So for 2024, the annual contribution limit that's set by the IRS is an amount of $3,200. Now, your employer can also contribute to your FSA, but that amount can't exceed the IRS's limit. FSAs are owned by your employer, so if you were to leave a job, typically you lose access to those funds unless you qualify for COBRA. And so that's something to take into consideration if you're planning on making a change in job during that next year. Rollover rules. FSAs typically operate under a use it or lose it rule. So if you use the money by the end of the year, you're good to go. Now, some employers do offer a grace period up to 2.5 months after that new year begins, or allows you to roll over up to $610 into the next year. But that is an option some employers use and others do not. If you don't have that option and you do not use the funds in that account by the end of the year, then those funds are forfeited. Now, there are tax benefits to these types of accounts, as the money that you contribute to an FSA is taken out of your paycheck before taxes and therefore reduces your taxable income. Now, withdrawals for qualified medical expenses are not taxed. So you get to get that money put into the account tax-free, and you get to spend that money tax-free as long as it's used on those qualified medical expenses. Now, FSAs do not offer investment options. The money sits in the account. It doesn't grow. However, it's to be used during that year. And at the end of that year, again, it's either forfeited or a small amount may be rolled over. The money in that FSA account can only be used to pay for qualified medical expenses for yourself, your spouse, and or your dependents. This includes things like doctor's visit, prescriptions, dental care, and vision care. Finally, with an FSA, you do have accessibility to the entire annual contribution amount starting on day one of the plan year, even if you haven't yet contributed that full amount. So if you do have maybe some medical expenses coming up at the beginning of the year, instead of having to wait until you save all that money up in the FSA, you'll be able to use it right away. Now let's talk about HSAs. Now, with a health savings account or an HSA, eligibility is limited to people who are enrolled in a high deductible health plan. You cannot have any other health insurance coverage, you cannot be enrolled in Medicare, and you cannot be claimed as a dependent on someone else's tax return to be eligible for this type of plan. The contribution limits, just like with a flexible spending account, vary annually. But for 2024, the contribution limit for an individual was $4,150. For a family, it was $8,300. And if you're 55 and older, you can contribute an additional $1,000 annually as a catch-up contribution, because not only can this account be used for your current health spending, but it can also be used as an investment account for your future. Now, the HSAs are different in another way from FSAs because they're owned by you as the individual. So that means that the funds are going to stay in that account even if you change jobs or retire. You'll still have access to that because it is owned by you. HSA funds can also roll over indefinitely from year to year. There is no use it or lose it rule like there is with an FSA. So you can use this type of account to save and invest money for future healthcare expenses. These accounts are well known for being a triple tax advantage account. This is because contributions are made pre-tax, reducing your taxable income. The money in the account can grow tax-free via interest or investments, and withdrawals for eligible medical expenses are also tax-free. This makes the HSA especially beneficial for saving over a long term and can be used as a tax-advantaged investment account. HSAs also allow you to invest the money once your balance reaches a certain threshold, which can help you to grow your savings over time, similar to a 401k or an IRA. These funds can also be used for qualified medical expenses, and there are guidelines similar to FSAs. However, after age 65, any funds that you have remaining in an HSA can be withdrawn for non-medical expenses without any penalty. Now, with an HSA, you can only spend the money that has been contributed so far to that account. You cannot use any funds that have not yet been deposited. But depending on your employer also may match some of or contribute themselves into an HSA account to help to cover those medical expenses. So just to review some of the key differences between flexible spending accounts and health savings accounts, when it comes to FSAs or flexible spending accounts, these are employer owned. They tend to have a lower annual limit, like this year, 2024, the limit was $3,200, and anyone is eligible to access and use one of these accounts. It doesn't matter what type of health insurance plan you have. Now, with HSAs or health savings accounts, these are individually owned. The limits are a little bit higher this year for an individual. In 2024, the limit was $4,150, and it requires enrollment in a high deductible health plan, with that being your only insurance and you not being able to be considered a dependent on anyone else's taxes. So these are the differences between an FSA and an HSA. So in summary, here's just a breakdown of some of the things we've discussed. HMOs or health maintenance organizations tend to have lower costs, but you have to stay in network and get referrals to see specialists. PPOs or preferred provider organizations tend to have higher premiums, but are more flexible so that you can see both in and out of network providers. EPOs or exclusive provider organizations have lower premiums than PPO, but no out of network coverage except in the case of emergencies. And POS or point of service insurance falls to the middle ground. They offer both in and out of network options, but they do require referrals for a specialist. And then finally, high deductible health plans have lower premiums, higher deductibles, and are often paired with a health savings account for tax savings. So now you know some of the basics that can help you to evaluate the options being offered by your employer and make the best decision for you and your family's needs. My goals with these videos is to help the general public to understand this complicated healthcare system that we have. And one of the first steps in understanding how to navigate this healthcare system is understanding the insurance and the benefits available to you. Please comment with any questions that you have about your insurance coverage or open enrollment in general. And remember that what you don't know can hurt you. Like, follow, and share for more.